Stocks taking a hit at the end of the week as the U.S. and China trade blows on tariffs. President Trump threatening a massive increase in tariffs on Chinese goods as Xi Jinping responds to U.S. port fees with new port fees on American ships and launches an antitrust investigation into Qualcomm. What does this mean for the markets and your money? Joining me now is Apollo Global Management Chief Economist Torsten Slok. Torsten, thanks for being here. Always great to see you.
Thank you.
Let's start with the news that tanked the markets on Friday. Tariff talk from President Trump reigniting trade war fears. Is this an overreaction or legitimate?
Well, it's now 6 months ago since we had Liberation Day on April the 2nd, and markets have been getting more and more used to the idea that maybe the worst was behind us. Yep. So the developments that we got here on Friday was that there is now more uncertainty potentially coming back. So this was indeed a surprise coming together with the other news, namely that maybe the shutdown will last a little while longer. And at the same time, a debate in markets about AI and valuations, in particular of the Magnificent Seven. So this was almost a perfect storm coming together that now suddenly we were about trade war again. And at the same time, we still have the valuation issue and the AI discussion. And we also now have the shutdown potentially lasting throughout October.
Do you, as an economist, worry about tariffs?
Well, the problem is that tariffs is something that takes time for companies before they begin to incorporate it. But we've heard very clearly, for example, from Walmart through the last earnings seasons, that when tariffs come in, of course, they have been saying prices are going to go up. And the logical conclusion is that sales will likely begin to go somewhat down. So this is why, from a GDP and a macroeconomic perspective, you should expect the same, namely higher inflation and also downward pressure on GDP. So I would expect, and this is also the consensus expectation and the Fed's expectation, that this is bringing back some of these fears about maybe inflation will now be higher for longer. And at the same time, maybe we'll have some downside pressure on consumption, on capex spending, and on overall GDP.
And when you look for indicators in the economy for all that, you're seeing fewer of them, or at least less data because of the shutdown. What indicators do you look at in the absence of a lot of government data?
Yeah, this has created a huge challenge in financial markets. We were supposed to get Friday last week the non-farm payroll numbers. We didn't get the employment report. So now, of course, we need to look elsewhere. That other places we can look is, of course, things such as how many people go to restaurants. There's a daily indicator from OpenTable that shows you how many people have been booking restaurants on their phones. There's also weekly data for retail sales. There's also weekly data for how many people stay at hotels. So there's a number of indicators you can look at, but none of these different indicators, including an indicator for how many people go to Broadway shows here in New York City. But even that, as a weekly indicator, it tells us something about discretionary spending, but it's just not the same thing as having the real GDP.
What are those indicators telling you, though?
So those indicators are still saying that things are okay. In the last week, we have still had steady, stable consumption, steady, stable hiring. There is no signs of the economy slowing down, but we're watching these indicators, especially those that are important for inflation and for employment, whether they are suggesting that the shutdown is beginning to have a negative impact. We're not seeing that yet, but of course it is very important to continue to monitor.
The Fed obviously monitoring this as well, trying to walk that tightrope between, gee, is the labor market deteriorating? Do we need to cut rates? Is inflation growing? Do we need to keep them high? The market right now predicts 4 rate cuts over 2 this year, 2 more next year. Is that the right policy in your mind?
Yeah, well, the problem for the Fed is that they have a dual mandate, which is inflation and unemployment. And both these parts of the dual mandate come out of the BLS. And the BLS didn't produce the employment report, so we now have to wait for that until the shutdown is over. But they did announce this week that they're now going to produce the CPI, meaning inflation report. They did that for a number of reasons, because this is something that we do need, in particular to calculate, of course, what goes into payments of Social Security, but also because now in financial markets, we will get some information before the FOMC meeting on October the 29th. So we will have one little part of the puzzle, namely what is inflation doing. But it is a challenge for the Fed. They are essentially flying blind when they don't have the data that they normally look at. And they get a lot of anecdotes and a lot of inputs and a lot of different indicators they look at, but it still boils down to this is just not the same as having the real indicators, especially when it comes to the job market.
We're just about out of time, but I got to ask you, you can't talk about the economy without talking about AI. All this capital spending is probably what's keeping us afloat. Is this a bubble, Torsten Slok?
I do not believe this is a bubble. I do believe that this is indeed supporting, of course, what's going on with the GDP numbers, because capex spending, especially on data centers, has been very, very strong and has been more than offsetting the slowdown we've seen on the consumer side. So the data center spend and the broader build out of the global industrial renaissance is certainly still giving the economy a good boost over the coming quarters.
We'll see how long it can last.
Thank you.
Torsten Slok, always great to see you. Thanks for coming in.
Thank you.